Avoiding taxes on your Social Security benefits can significantly enhance your retirement income and overall financial well-being. Social Security benefits may become taxable if your combined income exceeds certain thresholds, which includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits. By carefully managing your income and employing strategic financial planning, such as contributing to tax-deferred retirement accounts, timing withdrawals, and understanding the income limits, you can potentially reduce or eliminate the amount of your benefits that is subject to taxation. Implementing these strategies effectively can help you maximize your Social Security income and maintain a more favorable tax position in retirement. Manage your income. For the purpose of avoiding having your Social Security benefits subject to taxation, it is essential to have a total income that is lower than certain criteria. If your combined income, which is computed by adding your adjusted gross income, AGI, to any interest that is not taxable and half of your Social Security payments is less than $25,000, then your Social Security benefits are normally not taxable. This applies to those who file their taxes personally. This threshold is $32,000 for individuals who filed jointly. Maintaining a level of income that is lower than these thresholds guarantees that none of your Social Security benefits will be subject to taxation by the federal government. Consider tactics such as making contributions to tax-deferred retirement accounts, carefully timing withdrawals, or managing other sources of income in order to effectively manage your income. Maintaining your total combined income under these restrictions is essential for effective income management. Use tax-advantaged accounts. You can reduce your taxable income and potentially maintain it below the thresholds for taxing Social Security payments by making contributions to tax-deferred accounts such as individual retirement accounts, IRAs, or 401(k). This can be a proven strategy. Your adjusted gross income, AGI, for the year will be reduced as a result of the fact that contributions to these accounts are made with money that have not yet been taxed. It is possible to lower your overall income level by lowering your adjusted gross income, AGI, through these contributions. This can assist you avoid or minimize the amount of taxation that is applied to your Social Security benefits. Due to the fact that Social Security benefits become taxable when your combined income reaches specific limits, reducing your taxable income by making contributions to tax-deferred accounts can be an efficient method for managing your tax burden and preserving a greater portion of your benefits from being taxed. Roth IRA Conversions. Converting money from a traditional individual retirement account, IRA, to a Roth IRA will result in an increase in the amount of income that is subject to taxation in the year that the conversion takes place. This is due to the fact that the money that you convert is regarded to be income that is subject to taxation. However, this tax impact in the short term may prove to be helpful in the long term, as Roth IRAs allow withdrawals from the account that are tax-free throughout retirement. This is because Roth IRAs are designed to give tax-free withdrawals. This signifies that any future withdrawals, including profits, are exempt from taxation once the money has been deposited into the Roth IRA. This includes any withdrawals that are made in the future. The amount of income that is subject to taxation when you are retired could potentially be reduced as a result of this. It is likely that this approach will be especially helpful for you if you believe that you will be placed in a higher tax bracket in the future, or if you wish to avoid the required minimum distributions, RMDs, that are applicable to normal individual retirement plans. Both of these types of situations are the reasons why you should consider using this method. Invest in tax-exempt securities. Income from municipal bonds is typically exempt from federal income tax and may also be exempt from state and local taxes if the bonds are issued by your state of residence. This tax-free status means that the interest earned from these bonds does not add to your taxable income, which can be especially beneficial if you're aiming to keep your income below certain tax thresholds. By not increasing your taxable income, municipal bond interest can help you avoid higher tax brackets, reduce the taxability of Social Security benefits, and maintain eligibility for various tax credits and deductions that phase out at higher income levels. This makes municipal bonds a valuable tool for tax-efficient investing, particularly for those in higher tax brackets. Strategic withdrawals. Being strategic about withdrawing from retirement accounts is important for managing your overall tax liability, especially when it comes to Social Security benefits. Social Security benefits become taxable when your combined income, defined as your adjusted gross income, AGI, plus non-taxable interest and half of your Social Security benefits exceeds certain thresholds. If you're close to these thresholds, withdrawing less from your retirement accounts, such as traditional IRAs or 401(k), can help you stay below the income level where your Social Security benefits would be taxed. By carefully managing your withdrawals, you can minimize the portion of your Social Security benefits that becomes taxable, potentially lowering your overall tax burden for that year. This strategy requires careful planning as it involves balancing your income needs with the goal of optimizing your tax situation over time. Tax deductions and credits. Ensuring that you're taking advantage of all eligible deductions and credits is a key strategy for lowering your taxable income and maximizing your tax savings. Deductions reduce your taxable income, which can decrease the amount of tax you owe, while credits directly reduce your tax liability on a dollar-for-dollar basis. Common deductions include those for mortgage interest, student loan interest, medical expenses, and contributions to retirement accounts or health savings accounts, HSAs. Credits such as the Earned Income Tax Credit, EITC, Child Tax Credit, and education-related credits can significantly reduce your tax bill or even result in a refund. By carefully reviewing your financial situation and understanding the full range of deductions and credits available to you, you can minimize your taxable income, ensure compliance with tax laws, and potentially increase your refund or reduce your overall tax payment. This proactive approach is essential for effective tax planning and financial management. Review your filing status. Changing your filing status can have a substantial influence on the taxability of your benefits, such as Social Security or unemployment income, because it can change the percentage of that income that is subject to taxation. The amount of benefits that are subject to taxation is determined by the filing status of the individual, which can be single, married filing jointly, married filing separately, head of household, or qualifying widower. Each of these filing statuses has a distinct income level and tax rate. By way of illustration, married couples who file their taxes jointly frequently are eligible for higher income thresholds before their benefits become taxable. On the other hand, married couples who file separately may either lower or increase the taxability of their benefits depending on the particular circumstances. Because of this, selecting the appropriate status can help you reduce your taxable income, maximize your deductions, and make certain that you are not paying more tax on your benefits than is considered to be required. This modification can be an essential component of tax planning, particularly for those who have a wide range of income levels or who are dealing with complicated financial circumstances. Consult a tax professional. Personalized advice from a tax professional is invaluable because it offers tailored strategies that align with your unique financial circumstances. Unlike generic advice, a tax professional takes into account your specific income level, expenses, investments, and financial goals. They can help you navigate complex tax laws, identify deductions and credits you may not be aware of, and advise on how to structure your finances in the most tax-efficient manner. For instance, if you own a business, a tax professional can help you choose the best entity structure, like an LLC or S Corp, to minimize your tax burden. They can also guide you on how to optimize your retirement contributions, charitable donations, and investment strategies to reduce your taxable income. Additionally, tax professionals stay updated on the latest tax laws and regulations, ensuring that your tax strategy remains effective and compliant. By working with a tax professional, you can create a comprehensive plan that not only helps you save money on taxes, but also supports your long-term financial objectives. This personalized approach can lead to significant savings, better financial planning, and peace of mind knowing that your tax situation is being handled by an expert. Thanks for watching. Subscribe to the channel and hit the bell icon.